It's happening again. Just when silver looked like it was about to break out, bam, we get hit with a massive sell-off. What in the world is going on? Well, the CME group, the folks who run the COMEX exchange, just hiked the maintenance margins for silver futures. And if that sounds familiar, it's because this is a classic move we've seen before. Let's break down what this actually means for you and for the price of silver. First, what are margins? Think of it like a security deposit. When traders buy a silver futures contract, they don't have to pay the full price up front. Instead, they put down a small amount of money called a margin. The CME just increased this deposit requirement by about 18%. For the big players, the commercial banks and hedge funds trading thousands of contracts, this is a huge deal. Suddenly, holding their long positions, betting that silver will go up, becomes much more expensive. So what do? They sell. They liquidate their positions to free up cash and avoid the higher margin costs. This flood of selling pressure is what pushes the price of silver down. It's a classic shakeout. They create a paper tsunami to scare off the smaller fish and scoop up cheaper contracts. This isn't the first time we've seen this playbook, and it certainly won't be the last. Back in 2011, when silver was rocketing towards $50 an ounce, the CME hiked margins 5 times in just 2 weeks. Each time it triggered a sell-off, ultimately capping that historic bull run. Now, here's the crucial part. Does this margin hike change the fundamental story for silver? Absolutely not. All the reasons we're bullish on silver are still firmly in place. We're looking at massive industrial demand, especially from the solar and EV sectors. We have record low inventories in the London and New York vaults. And let us not forget the geopolitical uncertainty and persistent inflation that make precious metals so attractive as a safe haven. A margin hike doesn't create more physical silver. It doesn't reduce the insane demand. It's purely a paper market maneuver. What we're seeing is a manufactured dip. The big banks are using their influence over the futures market to manipulate the price downwards. They want to scare you into selling your physical silver or your mining stocks so they can buy them up on the cheap. This is a transfer of wealth from the weak hands to the strong hands. The question is, which side are you on? Are you going to panic and sell into the fear, or are you going to see this for what it is, an opportunity? For those of us who understand the game, these pullbacks are gifts. It's a chance to add to our positions at a discount before the next major leg up. Remember, the physical market is the ultimate reality. The demand for real, tangible silver is relentless. These paper market games can only suppress the price for so long. Eventually, the fundamentals will win out, and the disconnect between the paper price and the physical price will become impossible to ignore. So don't let this latest move from the CME shake you. This isn't the end of the silver story, it's just another chapter in the ongoing battle between paper and physical. The smart money uses these dips to accumulate. They know the long-term trend is up. Keep your eyes on the big picture, understand the fundamentals, and don't get spooked by the short-term noise. This is a marathon, not a sprint. Thanks for watching, and if you found this breakdown helpful, be sure to hit that like button and subscribe for more insights into the precious metals market. We'll see you in the next video.